Hello, everyone. Before we begin, understand this clearly. What you are about to hear is not a simple penny stock story. This is not just another under a dollar AI name that retail traders are hoping will magically turn into the next meme rocket. This is a pressure cooker situation. Right now, while the market is closed and most traders are distracted, Dvlt AI Inc., trading under ticker Dvlt, finished its last session at 79 cents. The move, up more than 8.5% on volume that was significantly above its normal daily average. To someone casually scanning a chart, it might look like a routine bounce, a little green candle, a temporary relief rally. But the real story didn't happen during market hours. It happened after the bell. And it revolves around a quiet but extremely important corporate adjustment. The company changed the distribution date of its upcoming warrant dividend. Originally scheduled for February 21st, it has now been moved to February 23rd, 2026. 2 days. That sounds harmless, right? In large, stable companies, yes. But in the microcap world, a last-minute calendar shift is rarely random. Timing is everything in small-cap structuring. Adjusting a warrant distribution date can signal coordination with a bigger catalyst, potentially aligning the arrival of those warrants with a news release, funding update, partnership announcement, or strategic development. This is not clerical noise. It's a flare in the sky. And when you combine that with Friday's unusually heavy trading volume, you have to ask yourself, is this the warm-up act before something larger? Now let's talk about perception versus reality. Most retail investors see Dvlt and think one thing: cheap AI play, under $1. Buzzwords, press releases, mentions of Super Bowl integrations, holographic tech, ultrasonic platforms. In today's environment, that combination alone can trigger speculative excitement. But excitement and sustainability are two very different things. Behind the headlines, the financial picture is much harsher. The company has reported annual revenue in the range of roughly $6 million, while carrying losses in the ballpark of $94 million. Let that sink in. That is not a small gap. That is a canyon. In a traditional valuation framework, that kind of imbalance would push a stock toward irrelevance. But markets are not always traditional, especially when volatility, narrative, and retail attention collide. Management has guided toward an ambitious target, $30 million in revenue for fiscal 2025. That's a tenfold increase. When a company projects that kind of growth, they are making a statement. They are effectively saying, judge us on this number. If they fail dramatically, credibility evaporates. If they come close, the current valuation looks disconnected from reality. This is what traders call a binary setup. High risk, high reward. And that dynamic alone attracts aggressive players on both sides. Now enter the short sellers. Short interest has climbed sharply, reportedly exceeding 16% of the float, with tens of millions of shares sold short. That level of bearish positioning reflects a clear thesis. The burn rate is unsustainable, dilution is likely, and the warrant structure will ultimately increase share supply. From a purely mathematical standpoint, that argument isn't irrational. Cash burn plus microcap structure often equals capital raise, and capital raises at low prices usually mean dilution. But here's where market mechanics complicate things. When short interest builds aggressively and retail attention intensifies, you create tension. Borrow costs fluctuate, days to cover ratios rise, liquidity tightens. And this is the key word, if a meaningful catalyst hits at the right time, those short positions can become forced buyers. That's not a long-term investment thesis. That's a mechanical squeeze dynamic. And that possibility is what keeps this stock from collapsing outright. Let's discuss one of the more talked-about developments, the private dinner at Mar-a-Lago involving CEO Nate Bradley, institutional investors, and political figures. When a microcap CEO gains access to that level of influence, the market pays attention. Access does not equal contracts, but access creates potential. Were government data security discussions on the table, tokenization frameworks, public-private initiatives, or was it simply networking? We don't know. What we do know is that the stock stabilized and then climbed following that development. Markets are forward-looking machines. They move on anticipation. If traders believe there is even a small probability of government-related revenue entering the pipeline, that changes the survival calculus. Because survival is the real question here. Not whether the technology is interesting, but whether the company can bridge the financial gap long enough to scale. Speaking of the technology, let's simplify it. Dvlt AI operates in data monetization, tokenization, and engagement technology. Their ultrasonic ADO platform is designed to transmit data to mobile devices through inaudible sound frequencies. The idea is that venues, advertisers, or broadcasters can deliver content directly to smartphones without traditional connectivity triggers. It's clever. It's futuristic. But technology doesn't matter unless it generates recurring contracts. Proof-of-concept demonstrations like high-visibility sporting events are great marketing, but investors need subscription revenue, enterprise deals, and predictable cash flow. Execution is everything. Now, shift to the chart. The stock remains below its 50-day moving average, which signals an overall downtrend. However, Friday's volume spike, nearly double typical activity, suggests accumulation at current levels. When volume expands dramatically during price stabilization, it often indicates stronger hands stepping in warts. The RSI has been recovering from oversold territory, hinting that immediate selling pressure may be temporarily exhausted. But here's the key. The psychological barrier sits at $1. Until Dvlt reclaims and holds above $1, this is still a prove-it chart. Failure at resistance could send it back toward lower support levels quickly. Now let's return to the warrants, because this is where confusion spreads among retail traders. A warrant grants the holder the right to purchase shares at a predetermined price. When exercised, new shares are created. That's dilution. Normally, warrant announcements pressure a stock downward, but in this case, the reaction has been mixed, even constructive. Why? Because the exercise price matters. If the warrants are priced significantly above the current trading level, they function as an implicit target. Management is incentivized to drive the stock above that price to make the warrants valuable. It creates alignment, at least in theory, Smiths. However, if price approaches that exercise level, short sellers face increased risk. Rising prices plus potential warrant exercises complicate liquidity assumptions. Traders should also monitor failed-to-deliver data in upcoming reports. Elevated short activity can sometimes strain settlement systems, creating forced buy-ins. Again, this is mechanics, not fundamentals. Online sentiment remains deeply polarized. One side calls it a scam. The other screams about moon potential. When sentiment splits this cleanly, volatility becomes inevitable. Smart participants look at the disconnect. They ask, what is noise and what is material? Super Bowl marketing exposure. Interesting, but not necessarily balance sheet changing. Dinner meetings with influential investors, potentially material. Warrant date revisions, structurally material. Learn to distinguish signal from spectacle. Another risk looms large, capital raises. With a high burn rate, Dvlt will likely need additional funding unless revenue accelerates quickly. If the stock rallies, management could execute an at-the-market offering, selling shares directly into strength. That strengthens corporate survival, but it crushes short-term momentum. This is the classic microcap dilemma, growth narrative versus dilution reality. Now zoom out to the broader environment. Speculative tech and AI-adjacent names have benefited recently from improved risk appetite. When macro conditions stabilize, high beta stocks often outperform. Dvlt is undeniably high beta. It moves sharply in both directions. That makes it attractive to traders, but dangerous to passive holders. Institutional ownership remains limited, which is typical for a company of this size. However, even small institutional participation can create a price floor. Funds accumulate gradually. They do not flip for pennies. If institutional blocks begin appearing without dramatic price impact, that would suggest quiet accumulation. Watch the bid side. Watch depth. Watch whether large orders absorb selling pressure without slippage. This is not a buy-and-forget equity. It is tactical. It demands attention. The revised warrant distribution date, February 23rd, is now the focal point. That is the timeline anchor. If management coordinated that shift with another announcement, it will likely surface near that date. Between now and then, expect rumors, expect volatility, expect narrative swings. Ultimately, this is a study in expectation versus execution. The expectation, a simple meme squeeze. The reality, a complex mix of financial engineering, political networking, aggressive revenue targets, short interest pressure, and survival urgency. You are not just buying a ticker symbol. You are placing a wager on whether management can convert access into contracts before capital constraints tighten. The market is already positioning for something. The question is whether that something is transformational or temporary. Stay disciplined. Watch volume trends. Monitor resistance at $1. Track insider filings. Pay attention to capital raise signals. And most importantly, do not let social media noise overpower actual structural data. Because in situations like this, the tape speaks first. And it speaks loudly. This is not financial advice.